we have in AIQ Trading Expert Pro, specifically sector rotation tools, to use that to not only determine which sectors to be in, but also what that gives us as far as information on the market. Segments of the economy are the best to be in different segments of the market. So just to explain this a little bit here, the green line is actually the economic cycle itself. This is how the economy, so you can measure that perhaps by GDP and other economic factors and measurements. The blue is what the market is doing. So market bottom, bull market, market top, bear market, late bear market, and the cycle tends to continue in that fashion. That's a broad generalization, but it's widely accepted. The key thing for us, the takeaway from this type of chart, is that look at the sectors, and again, we'll be looking at broader sectors is where we're going today. Look at the sectors that are the best to be in at different stages in the market. So this is really important for us. For example, when you look at the market bottom, as we come out of the market bottom, there's generally the finance sector and the technology sector that tends to begin to rise during that period of time. The economy may still be going down. I mean, GDP may be falling, whatever the measurements may be. But as far as the market is concerned, as we know, the market is a good predictor, is ahead of the curve on the economy. At that time, technology, finance, and cyclical come in at the market bottom, or at the very sort of early stages of the bull market. So those sectors move first. Good place to be in. But it also tells us, where the market may be. Once the market gets going, some of the other segments come in, like industrial, basic materials. And as we near a market top, we get to a stage here, basic materials is kind of, already on a great move. All of these sectors may still be moving up quite strongly. In fact, quite a lot of the sectors on the market can move up during this stage when we get near a market top. The key thing is once we get to that stage, some of these other areas are more favorable for us to trade in than these ones. So these are kind of like what I call latecomers to the game. They come in and then they start to move up when we get towards the market top. Energy and staples is a classic example, and we'll have a look at that in action. So when we get to the middle of the sort of early stages of the bear market, we get staples and energy. Then healthcare comes in, and finance and utilities. These three areas, and in particular these last two areas, come in late during the bear market itself. So that cycle tends to repeat. It's not, it's not 100% given law. For example, we know, right, that a lot of the market action, especially on the NASDAQ, has been driven heavily by a small basket of technology stocks that have been sort of pushing against the grain and have actually kept on moving until recently. So there is occasions where things don't fall into this generalized pattern, but this is a really good, I would call it a broad stroke look at where the market is. And we'll see that when we look at the sector rotations that we have from the reporting area. So what I'm going to do is we're going to look into a PowerPoint presentation, which is what I'm in at the moment. And we're going to look into the market log sector rotation. First off, I just want to give you some background of the information that we get from the sector rotation, where that's derived from, and then we'll look at some different stages in the last sort of 2 years using that sector rotation and what it can tell us. So market log sector rotation. So the sector rotation area, which we'll see in about 5 minutes, is within our AIQ reporting area. This is an area that's very unique in the software itself, and it gives us this dissection into the principal sectors. We will be looking at the S&P 500 as the foundation for those sectors. It gives us obviously a status of each of the sectors, and which sectors are bullish and bearish is really what it tells us, and we can use that as a gauge of where the market is as well, where the market's likely to go next. And of course, it also has some internal trend measurement that tells us which are in a strong trend or not, and which are accelerating or decelerating. So that we'll see in there as well. So what do we use to measure the sectors, and which we'll then use to gauge the market? Well, these are the indicators. MACD, of course, moving average convergence, divergence. Everybody's pretty much aware of that. So that's a basic price momentum indicator. So we're measuring the sectors, remember, based upon that indicator. Then a trend strength using the DMI, Directional Movement Index, another very widely used indicator. Supply and demand, so we bring in volume into the factoring here, but we use money flow, volume accumulation percentage, and on-balance volume percentage. So 3 supply and demand indicators are then used in this bullish-bearish sector indication. And finally, we use a positive volume indicator as one final volume, which is kind of outside of the other 3 indicators. So you've got a broad stroke of both momentum, trend, and also pressure to the upside and downside based upon volume built into the sector rotation. Simple things are the actual indicators in the chart itself is just a series of arrows, which we'll see in a moment. Very straightforward. If you've got 12 arrows, 12 just happened to be the number we picked for the maximum bullish. 12 arrows to the bearish side, obviously is maximum bearish. In between, you're in transition. You could have 6 that are bullish and 6 bearish, or you could have other combinations. It's not always going to add up to the 12 arrows, but it does give us an indication of which sectors are the most bullish and which are the most bearish. And it's that we can then use to gauge where the market might be going. So what we'll do is we'll look at sector rotation before I get into this particular example and why we picked this date. Let's just go and have a look in the reports themselves so we can see where this is located. If you're not familiar with this, obviously there's a program that's very comprehensive. I mean, many of you have used it for years, but you may not use this area. So within the reporting area, and obviously the main menu of the program itself, Trading Expert Pro 9.6, the most current version. The reports are actually here. And when you're in the reports themselves, the very last one is the summary reports, and there's the general market log that we have looked at in prior sessions. What we're looking at today is the market log sector rotation. When I select this, there are dates stored in here. I've just got a couple at the moment, but in our PowerPoint, I've got many more we're going to look at. So when I click on that, you'll see the sector rotation. When we're talking about those 4 indicator combinations that were used in this, the MACD, DMI, the third one, which does the supply and demand, including on-balance volume percentage and money flow, and the fourth one, which was a positive volume, all of those contribute to this bearish and bullish indication. And the trend score is also another factor that uses a slightly different combination of indicators. So this is a snapshot. Remember, we're looking at this on a daily basis. So this is a daily basis. These symbols here are the sectors that are created in AIQ for each of the S&P 500 sectors. And today, this is based upon those indicators we just mentioned. Here is the bullishness and bearishness. The trend score here gives us an indication of which sectors are on the move and in which direction. And we'll see, when we look at the illustrations in a moment, just how useful this information can be to us. So what we'll do is we'll look at this particular report from early back in 2022. So I'm just going to switch back to my PowerPoint here. We know what this was, 1322. Look at this. I mean, this is a market log. Remember, this one here is the entire S&P 500 market itself. These are the sectors within the S&P 500. Based upon all those indicators, at this point, 1322, a huge amount of the market is very bullish, as you can see here. Everything is pretty much in a bullish state of affairs. And at that time, there's a little bit of movement. Delta, by the way, DTS is Delta Trend Score. This tells us to what degree a group is moving up or down. Obviously, in parentheses is negative, or and in solid numbers here, like 32 is moving up. So the energy sector here, for example, is in a modest trend, but it's the most accelerating trend on 1322. So think about that. Right here, you've got a very strong market, obviously a very strong market. It was on 1322. You've got a lot of good trends in the sectors themselves. Very little happening. There's a little bit of movement in some of the sectors that are downside. The industrials have begun to roll over. But the key takeaway here is that the strongest trend, the change in trend up, this is a modest trend on the energy, and the delta here, 32, indicates that this is moving up strongly. So here we go back and we can go back and look at the chart itself of the, let me just go back to that. I'm just going to isolate this one here. I'm going to pop this onto a separate screen in a moment. So remember energy? So that energy sector, that trend, an accelerating trend, is happening right here. This happens near the market top. Energy comes into play at that moment. So that's what we're seeing there. We're seeing that happen, like the early stages or stages of a market top is when energy comes into play. Let me just what I'm going to do is just capture this. Give me a second here. So I can switch backwards and forwards to this without having to go back into the demonstration so quickly. Okay, so let's go back into where we were in here. So strong trend, 1,322. This is the most accelerating sector at that time. Everything's in a pretty bullish mode. You know, you could think this might go on forever, but there are signs in here that it's going to change. So how does that look in a chart? The best thing I can do in a chart itself is to go into my charting area and put up a overlay chart. So what I did in here is I went to chart and overlay, and I overlaid the SP 500 index onto the S&P 500 group sector structure, you could call it. And I'm just highlighting the sectors themselves. So once I put SPX on there, I've got the SPX itself, the index is in yellow. So that's on market. That's what we're trying to help measure and see what's going on. And overlaid on top of it in white will be the sectors themselves. So when I have SP 500 in here, all I need to do to move through the sectors, but to keep that, or keep the S&P 500 index the same underneath. So right now, this is some of the data from last night. When I click sideways here, you'll see I'm rotating through the S&P 500 sectors themselves. But the SPX itself, the index, is staying the same. I think the first thing you'll notice is how each of the different sectors, some move with the market, some don't, depending upon different stages in the market itself. So for example, the S&P materials here is moving pretty much in sync at the moment with the market. But there are occasions back here where the S&P materials has definitely been in a opposite direction to the market itself. This feeds into that sector cycle that we're looking at here. So let's change the date back to 1/3/22. This is the first measurement we were looking at there. Hitting the D key gets me back to that date. So we've been in a great market, right? I mean, I don't think you can disagree. This is a pretty good-looking bull market in the yellow here. I'll just leave it as highlighted on the first sector here. So during this phase, remember, during our image that we had there of the market, in a very good, strong bull market, there are lots of different sectors that are already participating in this. But at that time, when we were looking in this market sector rotation here, we know that even though with all of these, the industrials has gone slightly bearish, and the S&P energy is the one that's really beginning to take off. So this tells us that there is some sort of transition happening. So if we go and look at the S&P energy, check this out. This is kind of cool because look what happens with the energy itself. Remember, this is the late stages of a bullish market. So in this period here, the late stage of this bullish market, the energy is still, just high here. This is barely higher than here. This market is pulling back on energy all the way down to here before we start seeing this rally occur. So this is a sign that the market is beginning to roll into a new stage. And we know, obviously, with hindsight, that what happens from here is we're reaching a topping pattern on the market itself here. And as the market starts to roll down, look at what's going on with the energy itself. Energy is the topping area. In the topping area of the market, energy comes into play. And that's exactly what's happened here. It's been a laggard back here. And as we saw in that illustration, and I'll bring it back up again in my sniffing tool here, here it is. Energy starts at the market top. It comes into play. It hadn't been much in play before. All of these are still bullish, remember. They're still part of this. They're all part of this move in the market. Some of these, like healthcare, will come into play in the later stage. So we know when we see that sector rotation area, when we see a movement in something like the energy area, we know that something's beginning to change in the market itself. So remember, health is another area, but that doesn't come in straight away. So you can see health here is still moving around, not really doing anything. I mean, it's where the market itself has been going down, it's been following in sync. So in the later stages of a bear market, health will begin to become a better place to play. But at the moment, the only segment that's really in this market topping area, and this is still a topping area when we're looking at the late January, we don't know that what's going to come after this. We just know that we've had a pullback. So, but there's the sign is there in the S&P energy sector. And of course, after this, we know how things moved. There was some big changes happened overall in the market. We had a little period where we came back up and to this period here. And the health sector itself came into play really only in this sort of area here. Once the market started to move down, it only came into play from here to here. You can see the health itself has moved. Let me get this arrow up on this. Yeah, that's the one we want. There. So we know the market's here is this sort of neckline. The market's been coming down here and sort of still moving down a little bit. But during this period of time, here, the health has begun to move to the upside. And the market has also begun to rally a little bit more. But health did tend to keep up a little bit, and it's a little ahead of the market itself at this stage. But of course, the market is entering into bear territory, as you can see here. But look how well the health sector holds up. The health sector is still at this level here, whereas the bear market's down here. This is typical of this trend. So we're at this stage, the S&P market is plunging down pretty strongly. We're in this stage here. We're in this stage of the bear market where, let me see if I get it right here. We're in this sort of stage where energy, we already saw that early on in the market top. Then healthcare has come into play here. Better segment of the market to be in. So again, that they play into each other. You can see that what you see going on in the market itself is dictated by the sectors and vice versa. So if we go now and have a look at a little bit later in the time here, this is in 525 and moved it to. So that was the 1-3 log. We saw the beginnings of this. When we see this type of situation where energy, I always look for energy. If I see energy has been not doing a great deal and suddenly accelerates, it's a sign things may be topping out. And we'll see later what happens with, it's easy to see with the energy sector, what happens when the market's reached a bottom as well. The reverse happens quite often in the energy area. So 516, we're at 525 in the chart a moment ago. Look at the difference in our measurements here. Look at the energy. Energy is still really, really strong, right? It's really doing well. Health has just begun to come into the play here. So remember, that's in that sort of that we're not in the early topping. We're in the sort of early stages of a bear market. So again, when you see this, this is typically based upon standard accepted cyclical rotation from sectors of the market. You can see it actually happening in here. It's great to see. And look at these numbers. This is accelerating. Energy is hugely accelerating. That's where you would be investing, even though the market's definitely going down at that time. There's the market itself. Remember, this is the whole market. So there's a little bit of a rally coming in here. But again, this is, I've jumped forward to, to 5/16/22 from that January period. During that period, you can see what's happening. There are only a few areas in the market that are still working. Notice utilities come into play down here as well, right? So where does utility fit in on our cyclical plan? Right here, look at this late area. So it starts in the sort of bear market, mid bear market, late bear market. There's utilities coming into play. So that's a sure sign you're somewhere around here, right? You're somewhere around here. There's still room to the downside, but that's where the market is likely to be at that moment in time. That one caveat I mentioned earlier, look at the technology. The technology is kind of not playing the same ball game as the other sectors. It's not it's not really following the plan. It's gone bearish, but it's got 3 bullish arrows and it's got a high delta trend score. That usually comes, the technology and finance are the beginnings of the move, the market back up. So there's been a little bit of a counter move as far as the technology. And I think we've all noticed, right, that technology has been a little bit of an outlier and has really helped to carry an entire market. I mean, you only have to look at the I was discussing with a former colleague this morning about when you look at the NASDAQ and then you look at the Russell 2000, you can see exactly what is going on when you move away from that small basket of high technology stocks that have carried the NASDAQ to great heights in comparison to the overall market. So this outlier here is really, it's just unusual having that technology sector actually going up still and doing fairly well within a mostly bearish market. I should have a look at the, I'm looking at that. You can see, and real quickly here, I'll just chart a new stock. Russell, I think we'll put the RUT in here, make that a new chart. So this is the Russell 2000. If anybody keeps an eye on these indexes, you can see this doesn't look anything like the NASDAQ. And this gives you an idea of what the broad swathe of companies that make up the Russell 2000 versus, say, the NASDAQ itself. There's the NASDAQ as well. So you can see here, when you look at, here's the Russell, and here's the NASDAQ. I mean, look at the difference between the two. So there's definitely a little bit of dichotomy between what's going on in the broad market, and we're using the S&P 500, versus what's going on in the NASDAQ and the tech-heavy area. Let me just pop those out of there a moment. So back to where we are here. Going back into this 516. So we have, the bearish, these do one in bearish. There's still money to be made going to the long side in stocks within both of these sectors. There definitely is. Let alone the fact that utilities is beginning to come into play. And the technology, again, technology, as I said, I'm sure we've all seen it's an outlier. Any of those stocks, NVIDIA and Apple and others, we've all seen the charts and what's been going on there. But what we're finding out here is that on any given day, we can see where the cycle is in the market itself. So this is a bearish situation at 516.22. So let's move further forward again. This is 1010.22. So we've moved forward another 5 months. Remember, I was saying healthcare would be another sector that comes in later in the bull market, in the bear market. Here it is here. It's actually come into play. But there are also other areas coming into play as well. The industrials and the materials are all coming into play on the bullish side a little bit. So we're in the late stages of a bear market at the moment. Notice that the utilities has not participated in this stage of the bear market. So at 1010, when we go and change the chart here to 1010.22, so this is where we were in October, right here at this bottom stage in the market. We've had this rally up and things have come back down again. As I said, the healthcare sector we know has come more into play. It's definitely ahead of the market, but not by a huge amount. The energy, remember, energy came in at the top and continues into the bear market itself. Energy is still outperforming the market. You can see this whole period here versus the yellow of the market. That's the classic sign that we're still in that sort of bear market stage. Although near the end of it, the S&P utility here was doing better for a while, when we were up here, right? Outperforming the market considerably, but has definitely dropped off since then. So it could be a sign that we're near the end of this particular move to the downside. And as we know from looking at this, remember the next stage is when we look at our illustration of the cycle. So remember, the late bear market includes finance should be coming in, healthcare should be coming in. Utilities in this case is a little bit of an outlier. And just before the movement to the upside again, or as soon as the market turns around, finance and cyclicals will come back into play. So right now we're at 1010.22. So we're sort of in transition. We've definitely been going down pretty strongly. Definitely looking at bear market. And in that period of time here, as we go forward, you can see the utilities have started to move away a little bit from the NASDAQ, from the S&P 500. So you can see here, we've got back to the stage where utilities is now pretty much outperforming the market, as you would expect in this sort of bear market type of scenario. So when they talk about bear and bull markets, I mean, the measurements of 20%, is the beginning of a bear market. Those numbers are always thrown around. I don't think you can say that, okay, from 36.48 up here down to this low point at 28.55, you're talking about 730 points. You're talking about pretty much down at the edge of a bear market. We know how far it went down to at this point here. So this is, you're seeing the early indicators. When it says early bear market, you're not sure it's a bear market unless you can see some of these sectors that are actually leading the way down. And that energy is the one that really tells you a big story. And I was going to say about energy itself, when you look at the energy, when it's spiking, nearing a top. So if you go back in time to here, and I just want to show you this, how good this is, the energy itself. When energy reaches a top right about here, right, the market's had a good pullback. As soon as energy starts moving away, the market starts heading off again. And you see this happen on numerous occasions. It's like you reach the top here and the market's had a good pullback, energy pulls away, the market goes off in the opposite direction. Doesn't always happen, but in a lot of times it does. There's almost an inverse ratio there. So at this point here, when we look at this, here's in the white, here's the energy sector again. It's at a new, it's at a new high. Look where the market is. It's pretty much down. As soon as that starts falling away, a few days later, this starts to move to the upside on the market does itself. So there's a good transition between the two, although they do move in synchronicity together at times. But when you get these peaks on the market, the energy, itself, it's often when the market's nearing a sort of short-term or even medium-term bottom. So back into let's go back into our log here. So remember, this is run every single day. You've got this information in here. Notice on this 10-10 day when the market's really in really bad shape, and the delta trend means it's changed from previous day. Everything's dropping pretty badly. The only sector that's really strong is the energy still. Energy's still strong, but it's moved down a little bit. So if we move forward again into our next chart, which is quite a bit forward in time, 7 months or so, into June of this year. So you can see there's been a change. I mean, when we were in October, things were pretty much a long way down. We've had some transition here. The market overall is pretty bullish, but look what's now, technology is back into the fore in a big way, right? Finance has come back into the fore in a big way. Look at the delta on this, 108, pretty impressive right there. Technology was already in a good trend. So at this stage, at 6/5/23, you've got some of these leading areas like finance, industrials are good, materials are looking pretty good. Still, some of the areas are, these areas here, but these are part of the latter stage of the market, of a bull market, and not doing quite so well. So when we look at our chart again, this particular chart here, finance, cyclicals, industrials. The finance and the technology are both moving very well, and this is the beginning of a turnaround in the market. How long that will be when you say a bull and bear market, these terms are not, as far as how big or how long a bull market or bear market is, are subject to different cycles and different changes. We can look at this as we are on a daily chart, and we're seeing this sort of cycle happening within a daily frame of mind. If you went to weekly and tried to do this, we don't have this information weekly. You may see much longer term cycles that these smaller cycles are taking place within. So here, technology and finance, this is the beginning. The economy will still be, uncertain at that time, but they're beginning to turn around. And you can see that when we go and look at the chart here of 6/5/23. Again, we're looking at the S&P 500, and we're comparing it to the S&P 500 sectors, and I'm changing the date to that report date. So here's the big change in here. I love this chart. It's a great illustration again. Remember, there's this pretty nice measured move down to this point here. At that time, at this sort of bottoming area here, the S&P has begun to make a sort of bullish look. Once we get to here, we're getting higher lows and higher highs. We're definitely getting a bullish look to the market itself. The energy itself, remember, energy was part of that bear market, followed along in sync until we get to here, and energy starts to fall away. So this is now no longer part of the best sector to be in. Notice here, energy reached a new high. That's it. It's done for. When it was here, energy reached a new high. The S&P was a kind of a new low at that point. Same around about here. Not exactly right, but very close to it as well. So energy's out of favor. We know finance now will be back in favor, right? But not a huge amount. Not a huge amount. Remember, we only saw 3 bars on that, but certainly it's doing better in this bit here than it was in the previous charts we looked at. We've had some hiccups in the finance sector as well, which sort of comes outside of this paradigm that we're looking at. Obviously, we know the regional banking issues that happened here, and that caused this plunge down in the finance sector itself. Other segments of the sector were doing okay, not as badly as the regional banks, but again, so even if this aside, there is no doubt that the banking, the finance sector is doing better than it was. Technology is the biggie, of course. As we know, technology has been doing very well throughout this market time. It has kind of fallen in sync with the market anyway, but again, here it's outperforming the market a little bit at this moment. It's come all the way up to here. Let's get rid of that A there. So the technology is definitely leading, along with the finance. Is still a little early in it, so it's a little bit of a recovery. So we're at the early stages of a move to the upside. So when we look back, this particular market log here, we are looking a little bit more bullish. There's still some areas that are definitely bearish, but we believe that technology, we believe that the finance sectors are both areas that lead the market at that stage, and they certainly are doing so. Real estate, this one here is also leading the way at that time. That's we haven't looked at. Let's go have a quick look at that one. Here it is. So real estate has been as we know, has been the commercial real estate, particularly that segment has taken a beating. In this area here, very similar to the banking, the two are very closely tied together. The same period of time here, things have rallied, and this pullback is an anomaly again. Again, that's all part of that regional banking and the interest rates. Commercial real estate definitely under some pressure at the moment. So that's 6.5. Let's move forward into 8/7/23. So this is the beginning of August. Things changed around again. So look how bearish things suddenly turned on the market on 8/7. And again, guess what's changed again? Guess what suddenly popped back into favor? It's energy. As soon as things look bad, energy is the place to go. Finance is still holding up. Health has come in early this time. Industrial and materials are as well. And amazingly, the real estate is holding up really well. But you wouldn't want to be in utilities or technology. So again, remember, utilities are really do well late stages in the bear market. Technology, we know, is usually in the early stages of a bull market and throughout a bull market, although this has been behaving a little differently recently. So in this case, S&P energy again is looking really strong. That tells us that the market's going to be weaker again. This is the area where you would be investing. You see this and you think, well, yeah, if energy's strong again, then this market may be tipping over. So, when I go to it's 08/07/23, I head into this area here. You can see what's been happening here is that the S&P has had a really nice run up. Everybody's been talking this bull market up. It's been doing really well. Remember, health sector was one in the late bearish stages, so it's lagging behind the market. Of course, it's not the best place to be. Back to the energy, though. Energy is just like, off it goes again. It definitely is, it's a good segment to be when the market begins to roll over like this. And, when you roll this over, and I'm moving forward here, look at that energy sector again. It's right up the top there, whereas the S&P has definitely fallen away. So, again, this is the beginning of August. Things changed around again. So again, the period of time where you can take advantage of these things may not be that long when you're in a topping area within a market. But this, to me, that looked like a topping area because energy's gone way back up again to this top level here. And it's way up here like it was here and up here like it was here. So the market itself, it could correct. I don't know. I mean, we know that we're seeing indications that we've got a bit of a move to the downside underway at the moment. But guess what? Energy was roaring its way still to the upside. Health, of course, comes second. So where is the health? Health hasn't yet changed around. Of course, not come around that to the being the best segment to be in. When I go back into to this general paradigm here, energy staples. So staples will come into play at this top as well, and in the beginning of the bear market. Healthcare comes a bit later. So let's have a look at the staples, see what they're doing in this area. Still hasn't really made much of a difference as far as compared to the S&P 500. Still kind of moving in sync as the market has gone to the downside. So now we're in like late August itself. So it's real interesting to see that rotation. I really, the finance, the energy, and the technology. I like, the finance and technology are good indicators when a bull market is beginning to move again. And seeing that within this area here, oops, wrong area. Seeing that within here is one of the first indications that some change is happening. It really is kind of good to see. You can save a lot of these market logs. You can generate a whole pile of them and actually see this transition from day to day. I've obviously picked different segments of the market, illustrate how this can pan out. Obviously, if S&P utility is this strongly bearish, right? It's almost certainly you're near the top of a bull market, or you're definitely not in a bear market at that time because this only comes into a great sector like the computer, like the cyclical areas, the non-cyclicals are a good place to be when the rest of the market, the leaders have given up and the market is rolling over. We know there are safe places to invest when the market is in a bear market or near the bottom of the bear market. So the market log for 8/7, that's it on the screen here. Here's the market log from last night. So what are we still seeing in here? It's again an indication that the only positive delta trend score is on the energy. Guess what? Energy is the only segment that's rising. I mean, this is some of the others have still got a little bit of bullish hangover in there. The S&P materials, the technology is still doing its bit, still hanging out there. But there's still signs out here that things might be rolling over again. Look how negative all the rest of the sectors are. They're all turning down. But energy isn't. And what comes after energy? If this continues, if we think this is going to be, beginning of a move to the downside, then we're likely to see more of the staples and then healthcare. When healthcare comes into play, when we start to see delta trend score on healthcare, then this is probably a beginning of another minor bear move or market. Again, I'm not an expert on how big a move is or how long it's going to last. I just know that this rotation happens. We can see it. It's not 100% correct, but it actually gives us a pretty good indication of where we are at any given time. Utilities is great when we're in a late bear. Right now it's not great. So we know that we've been in a pretty good measured move to the upside. So that's pretty much it I wanted to do on the sector rotation. We've got 45 minutes each. I pretty much used up my time. If you've got any questions, fire them away in the box there while I just get rid of this overlay on the chart here. And move that overlay. And just again, this is when I move this forward to 9/6. You can see here, some of these sectors themselves. Look at the difference between each sector. I mean, the market's moving one direction as an overall, but within the market itself, there are lots of different things going on. I mean, look at the consumer staples has pretty much gone nowhere, right, in this whole period of time here. I mean, it really hasn't gone anywhere. Whereas the market's done a lot more movement down and up, and this is not unusual. And here's the energy sector. I mean, look at that compared to when we're looking at consumer staples. That's been definitely much stronger, and definitely stronger in the periods when the market has been going in the opposite direction. Finance, there was the glip there from the regional banking problem. If you took that out of here, this might look a lot stronger. As it is, it's not looking great either. Health again has been pretty much stuck in that sideways we saw a moment ago. Here's the industrials, which has been doing pretty well in overall. But when you compare this to the overlay of the S&P 500, let's do that again. Look how close these charts are to each other. Right here, recently, it's been outperforming the market a fair bit, but it does move fairly in sync with the market itself. So I'd suggest you have that overlay up here so you can see exactly what it is that the sectors are doing. And if you see energy doing well, you're near the top or the beginning of a bear. If you see utilities doing great, you're probably near the bottom of the bear. As soon as it's finishing, it's moved to the downside. Finance comes back in, beginning of a bull market, along with more into technology. Although, as I've said, that's been an outlier recently. Okay, so that's it for me. David, are you there?
I am, Steve.
Hey,
yeah. Good talking to you. And that was excellent, Steve. I thoroughly enjoyed that.
Good.
I do a lot of sector and industry group work myself. And I have to say that Delta Trend Score, the predictive behavior of that really, I'm going to be taking a very, very good look at that. That was excellent. Thank you, Steve.
Yeah, you're welcome. Let me make you host, David, so you can share the screen. Yeah, and as I said to everybody, the recording will be available later, both David and my session. So it's all yours. I'm muting myself.
Okay. And let me see here. I'm going to try and get my screen up. Can people see this, what I've got up?
No, can't see it yet.
Oh. What am I not doing here?
Let me see. Yeah, you're definitely host, right? Yep, you've got the host all right, so.
Let's see. Oh, okay. Here we go. Sharing. Share this.
Yeah, here it is. I can see your Zoom now.
Okay.
I see your browser. So.
And do you see something now? Are you seeing two different screens or are you seeing one?
We see the two.
Okay, that's not what I want. Okay, let me back that up. Okay, that should be. Okay.
Yeah, absolutely. Yours looks good, David.
Okay, thank you, Steve. All right, everyone. For those that are not familiar with me, I'm Dave Wozniak, Chief Market Strategist with Trading Floor Research. In the past, what I've actually done is I've given webinars with Steve that I've talked about the different aspects, the different tools that I use in really my process. Today, what I'm going to do is I'm actually going to utilize those tools a little bit instead of getting so much into the teaching part of this. I'm going to actually be using the tools to kind of give some an idea of what I do on a daily basis when I actually give subscribers the information that I do. And what I'm going to talk about is, I guess I'm going to call it my fall market forecast. And this kind of goes very well into what Steve was talking about here. Where I'm going to actually start this, though, is we're going to talk about market observations of the S&P 500. I'm going to talk about the Magnificent Seven, but unfortunately for time reasons, I'm only going to cover 3 different stocks in the Magnificent Seven. And then I'm going to end up with these things that even Steve mentioned in talking about financials and how I kind of really messed up the financial sector. We're going to talk about the regional banks to finish this up. The reason that we're doing this is I want to start with the S&P 500 in talking about what I actually gave a webinar on about I'd say a little more than a year ago, back in August. And I talked about my bear market forecast and my bear market model back about more than a year ago. And after that time, of course, the market did go lower, but it didn't go anywhere near what my predictive numbers are. So we're going to kind of go back to that right now and take a look at what has happened and why I feel this model that I talked about, and I'm going to quickly go through it again, is telling me that this bear market still appears to me to be unresolved. And so let's take a look at this model that I actually put together. And it spans over multiple bear market and bull market cycles. And what I actually discovered in these 155-month bull market cycles go beyond what this page even shows. But I'm showing kind of the last 3 of these 100. And so again, this encompasses the time period, 155 months, not of little blips of bull cycles, but the complete bull market cycle before you head into the bear market retracement or the bear market cycle. And then you begin a new bull market cycle, a bear market period, and then another bull market cycle. And what I actually found was that these bull market cycles can be measured almost precisely with 155 months. And we're just going to go right over to this latest bull market cycle that began in March of 2009 and ended 155 months later. You can count it out yourself. The exact ending of this, just like other bull market cycles, this one ended in January of 2022, precisely right at the top. And so the whole predictive nature of this model says, well, if each one of these cycles are 155 months, and each one of them go to a certain bear market retracement. Now, the one thing the model doesn't have, because it doesn't exist, is every bear market has a different period of the bear market. And actually 1987 was one of the quickest. That lasted for about 2 months, but it did its damage. The retracement was a 50% retracement. And what I'm talking about here is taking back 50% of the entire run is taken back before the next bull market cycle started. Then we went into the early 2000s, which the first leg, possibly similar to what we're seeing right now, the first leg of this cycle went 50%, rallied back up to the top, and then gave us the end of the bear market cycle, which actually in this one ended with 2/3 or 0.618 of the entire distance of the previous cycle. And again, here we are again, rallying all the way up, ending at 155 months. But look what happened this time. We really terminated this thing around a quarter, which again takes me to the idea that this bear market cycle isn't quite resolved yet. So let's dig into this a little bit further. Here's going back to 1987 again with the S&P 500. And I love to draw these long-term trend lines. I love trend lines. I think trend lines have so much predictive nature to them. And if you draw a trend line along the tops, major tops, and this goes for markets as well as individual stocks, whatever you might be looking at, it's amazing. More than 90% of the time, the end of a major move of any stock, a termination move, will end at the top point that you've drawn years before on this chart, and it will typically terminate at that point and then start to turn down. What's interesting about this is this was in the rare case that it actually exceeds the trend line. And in those rare cases, and like I said, that happens, less than 10% of the time, way less than 10% of the time. I would say it's even less than 5% of the time you see this happen. But when it does happen, it's pretty exciting, because what occurs is a parabolic move. And that is exactly what we saw in the S&P 500 once it took out that major trend line. And by the way, it took it out right at about just below 3742, which was also a major extrapolated Fibonacci number of mine. That was a Fibonacci expansion number. Where we ended up terminating on this move was 50% of the distance between the next number and the lower number. And you can see, I'm not going to go through all this, but you can see the way this model has also, from 1987, my Fibonacci numbers have just bounced off of all these different numbers all the way up. And here's the 50% numbers, came back down. Here's March of 2000, the COVID crisis came right back down to that 2395 number before we started back up again. And here's what's happened here just, in this latest bear market, though. Once we broke that trend line, rallied up, and here's where we terminated this, I think, what is probably the first leg of this move. We terminated right again, retesting that major trend line. Now, what I'm going to tell you is, if we would have sustained below that line, we would have gotten the move. But it actually caught at the number, at my big number again, got caught at the big number and started to move back up the other side. So I think what I'm watching for now is taking back that major trend line and taking back the 3742 number. Once we see that again, I think this market starts to resolve. And again, the resolution could take us down to 2742 at a halfway. And again, this is the halfway point of the entire bull market run, 50%, or it may go down to the 0.618 like we saw in 2008, which gets us down to 27 or 2252. So anyway, that's where I wanted to start this discussion again, because again, I feel like this market is unresolved. Now, just like we saw in 2002, termination was in 2003, and then the termination of the 2008 was in March of 2009. Both of those termination of bear market periods actually occurred in the spring. So maybe this happens again now and we don't get that final termination move, or the move lower like this, that may not even occur until the spring again. We might not, this leg down may not be the one that does it. But again, the way we're going to know that is by keeping an eye on these numbers. And the numbers that I'm looking at right now, it's kind of interesting. Here's where we are basically today. I didn't include the end of day data today, but what we did do, now I'm going to tell you some significant things happened this week, which I notified my subscribers about even this weekend. I said, keep an eye on this 4486 number. Why did I want to be watching that 4486 number? That is 3/4 of what I call the bear market, or the bear market number. That's 3/4 of the number. Here's 100% of the number up here in the 48 area, 4,830. That's 100% of the move. 3/4 of the move is a couple of things happen at 3/4. Reversals can happen at 3/4, And it also is a strong move. Now, it's not as strong as 41.55, the half number, which, by the way, when we were trying to crawl up there, I highlighted that in the newsletter, the resilience, and we're not even seeing the full chart back here, the resilience of the market when it was trying to break that 41.55 area. It took a number of weeks to try to break that. But once it finally did break through, we were off to the races here. And we got just for a couple of weeks above this major three-quarter number, which kind of looked like maybe we were going to start to test that, go all the way up. Because again, the 7/8 number is not a strong number. Once we took that out, typically we can head back up to the top. Then we peaked our head above the number again just about a week ago. And now this was pretty big. This week, we gapped below the number again. So now we're in the danger zone, and we're furthermore in the danger zone when you look at from the July high to the August low. I'm always looking at 50%. That's strong. Yesterday, we also closed below 50% of that range. What does that do now? That puts the bears back in control of our latest rally attempt. And again, today, what did we do? We came down and tested 44.34, which is some Fibonacci support area. And we also threw back into this declining trend line. So far, we're holding up in this area. We've got a time cycle turn date on September 13th, breaking these areas, 44.34 and 44.03, gets us down to the next leg. What's the next leg? Well, the 5/8 number of the whole move, 43.11. Breaking 43.11, that could get us down to 41.55, which is very interesting. Once we get there, that becomes a do or die point for this market. So we'll see where this all heads for us. But that's the kind of stuff I post in the newsletter when I give my market comments, just keeping you posted on, hey, I'm not trying to predict the market with any of my own feelings. I'm just trying to use what I know about these numbers and the predictive nature of these numbers to say, hey, look, just like we did right here, breaking 44.86 was very, very critical. And as a matter of fact, any rally back to 44.86 right now, or even 44.71, could open up for a very good shorting opportunity too. So that's the kind of stuff I would post as trades in the newsletter. So the thing, of course, everybody knows, like Steve even pointed out, is the fact that, hey, the Magnificent Seven is really what got this market to the point that we are right now. And this whole rally was really, a lot of it was based on the Magnificent Seven. And so a big part of my analysis now, and unfortunately I have to make it a big part because these stocks have become so important to what the market is doing, that even in addition to my sector work and everything, this has almost become an industry group of itself called the Magnificent Seven. So the important thing here is, what is the Magnificent Seven doing right now today? And here's where it's at today for me when I do my analysis. And of course, we're not going to be able to run through all of them, but I'm going to give you Tesla, NVIDIA, and I'm actually going to include Alphabet. The reason I'm going to include Alphabet is because out of the Magnificent Seven right now, the only, and this is from my analysis right now, the only, and this has been for the last number of weeks, the only Magnificent Seven stock left in a buy signal right now is Alphabet. And we're going to talk about Alphabet because I got to tell you, any sort of market move that starts to look like this market can trend higher again, if you're looking for the big market cap beta stocks to go into, my first choice on the list would be Alphabet. And as a matter of fact, that's what I would put in my newsletter too. So for subscribers, you would get the point where I would be looking to put my money into Alphabet. But we're going to start out first by taking a look at just a couple of the stocks that I think are troubled right now. Of course, unfortunately, I did this over the weekend, so I didn't include, Apple may have been one I would have included because of the recent troubles this week. But we're just going to cover Tesla and NVIDIA here, just to, again, look at what these magnificent seven stocks are doing. So again, a big thing that I look at, I post to my subscribers is the point and figure charts. Tesla, now, it doesn't even show up on this point and figure. It goes beyond this at this point. But back in January, the first couple of days of January, you can read it. You can go back into my library and check it out. I actually posted that Tesla was a buy based on a big part of it on the point and figure with the long tail down. And that was at about 104. And of course, this move so far has terminated at about 296. So almost a 200% move since that long tail down got you in. Now, here's what's interesting, though. Where are we today? More importantly, well, this is something I've already talked about in my newsletter, and I pointed out. Not only did we do a triple bottom breakdown on the point and figure, this triple bottom just recently turned into what is called a catapult formation, which sent us considerably lower, pulled us back up without giving us a buy signal, and kind of muddled us around again. And guess what? As of today, we're looking at this thing right now that we're ready to give another double bottom breakdown from the catapult formation on Tesla. Tesla just seems to get more and more negative from every aspect that I'm looking at. But this is the point and figure chart. Let's look at the bar chart right now. Now, a big thing that I actually look at, and why I'm pulling this one up right now, is I talked a lot about in my newsletter is about this thing called an up-down volume ratio. And of course, what that incorporates is, when institutions are typically buying or they're selling, I was a portfolio manager in my past life, and I know this, is that I typically didn't go in and buy my full positions all in one day. I would stagger them over, a few different days, not to push the market myself and that type of thing. And that's what institutions do. So yeah, I want to see that volume, and I want to see those volume days as keys to helping me. But the other thing to do is just have a process that adds that volume all up as far as negatives and positives. And it happens over a 50-day period of time. And that's what the up-down volume ratio does. And it gives you a good idea of where that volume is actually going, up or down. Well, as Tesla was rallying, of course, we were seeing some accumulation coming into the stock. Look at what's going on right now with the stock. You're seeing the up-down volume now on this stock is near 100-day lows. By the way, the gold line or the yellow line is 100. The blue lines are 20 days. And of course, we've been breaking 20-day lows, but also the raw number, the absolute number of the up-down volume ratio at 0.96 says it is under distribution right now. So anything above 1 is accumulation. Anything below 1 is distribution. So not only is our trend moving down of up-down volume ratio, we're actually under distribution right now. So let's take another look at this. Here's what's going on as we've moved into distribution, which is very interesting because this is typical of what you see in the early stages of a stock starting to break down like Tesla is right now. First of all, look at what's happening at my 50% number. This is 50% of the bear market move again, from high of the bear market to low of the bear market, 258.16. Rallied up to the 5/8 number, topped out right there, held at the half. Of course it is. I'm sorry. Held at the half number, broke down, rallied back into the half number. But look what it's also doing at the very same time, rallying into the 50-day moving average, which, by the way, a lot of institutions that's the only thing an institutional person, these fundamental guys know, is I either buy on the 50 or I sell on the 50-day moving average, which is very interesting that the two are right above each other right now, these two hard numbers. What also is interesting, I had a time cycle turn date on August 31st, which at this point is marking the high point of this whole move. How did I get that time cycle turn date? The easiest way to do this, very easy, is draw your trend lines. When you're dealing with long-term trend lines like this, where trend lines cross, it can often give you where price can turn. And that's exactly what I did right here. And it looks like we're getting a downturn now in Tesla. Here's the projected numbers: 219, the Fibonacci projections, 170, we'll call it 180, and 141. Those are my projected downside numbers right now. We'll see how that all turns out. So that's Tesla right now. Also, what I did in the newsletter is I already bought yesterday, based on this, I put in the newsletter to buy TSLS. So we're already in this position right now. TSLS, of course, is the ETF that represents the bear move. So I don't have to short Tesla. I can just use an ETF. I'll use a lot of these in my newsletter and for myself in trading. Instead of trying to borrow shares and deal with all this, you just use some of these ETFs, inverse ETFs. And this actually telling you the same story. Double top breakout, pulled back in beautifully into the pocket, and here we go. Just to get back into the pocket area, even if this runs and I pointed this out in the newsletter too, even to get up to the pocket area of the point and figure, that's about $26 from where we are down around 19 to 20 right now. That's a 30% gain just to get to the pocket area. If we go to the bearish resistance line, that could even get us up to the 36, 37 area. So we'll see what happens with this move. But that's the different looks I have on it. Here's NVIDIA. NVIDIA, same type of story. I mean, very bullish point and figure chart. And then we started to see some breaking down here. We finally got to our top point. On the point and figure, we already got a double bottom breakdown, rallied back up without giving a buy signal, reversing back down again. Here's today, reversing back down, ready to give us a triple bottom breakdown. The only thing in our way right now is the bullish resistance line or support line that comes in right around 440 on the point and figure chart. We break this down, and I would say you're going to run in some air pockets on NVIDIA, and things could start to unravel. So there's what I'm looking at right now on NVIDIA. Now let's take a look at what's going on with the up-down volume ratio. Well, we've been making, even before these last earnings came out, we've been making 100-day lows on the up-down volume ratio. Although the actual number, the absolute number, is very neutral right now. So we are neutral. Here's what's going on with it, though. Today was very, very interesting as it's been coming down. We actually could have done, as it started the day, let's take a look at it from this slide. I think it's easier to see on this slide. Here's what happened today on NVIDIA. As the day actually started, we actually were ready to break. By the way, this marks a time cycle turn, which is today. So we could get a little rally up here in NVIDIA. I would not be surprised. Why? Well, not only did we come to where two trend lines are crossing today, also the pitchfork lines actually meet at exactly, Andrew pitchfork lines meet exactly at that point too, my Andrew pitchfork lines. And also we got a throwback into this trend line too. So a lot of things happened today that kind of held NVIDIA up. So we might see another pop. Now, does this pop get us back up to the 493 number? By the way, this is a big number for me on NVIDIA. This is 1.618. Extension move from the entire bear market base, which you can't see on this. But once it broke out of the bear market base, I even posted in my newsletter. This was months ago when we just broke out of this on the last earnings report. I said, you know what? The ultimate target on this thing, be watching for 493.55. That is exactly where we rallied up to. Now, if this is just the outside chance right now that we take 493.55 out in the immediate future, the ultimate number on NVIDIA, and this goes all the way back to get these numbers for me, I have to go all the way back to the beginning of trading on NVIDIA and extrapolate these numbers. 578.38. This is a huge number. This is very, very important. If you're trading NVIDIA, I'd be marking that number down. 493.55 is also a big, big number, which again, it's having some problems with here. Even here was our last earnings. What did the earnings do? Gapped it a little bit. Literally, this lasted for about 5 minutes above 493.55 on that earnings report, and then it started to collapse. And again, look at how you challenged that number a couple more times. Would it surprise me if we came up and challenged 493.55 again? It would not, for the simple fact that we still are in neutral for the up down. So we're not breaking down right now. A distribution is coming into NVIDIA right now. The sell signal on NVIDIA, which is really kind of interesting though too, this one blew me away, is the sell signal, my sell signal on NVIDIA happened way back here in August. This whole move higher into the earnings happened without giving a buy signal. NVIDIA is still in a technical sell signal for me, like I said, with 6 of the other Magnificent 7 stocks. But it looks like there is a possibility that we do get a little rally in here. Now, if that rally terminates and we start taking out these levels again, that's when we start looking to the downside on NVIDIA. And these are my different numbers I'm looking at on NVIDIA, but I want to point out the huge ones, the ones that go all the way back to the beginning. 357.12. This number is unresolved as far as I'm concerned. We gapped this number on 2 earnings reports ago. We gapped this number, and we never came back to resolve this number. If there is any sort of a decline in NVIDIA, this would be a big candidate for me as a resolution of 357.12. Keep that number. If you broke that number, which again, because NVIDIA has turned into such a darling, I don't know if you break that number, but if some outside chance happens, you broke that number, the next huge number down happens at 220.72. But even in any kind of a market hit or anything, this would be a big number. Again, I'd focus on these smaller numbers too. They're all important. But, oh man, if you got down to 357, where again, you would get resolution to this chart, because I really feel like it's unresolved at this point. So that's what we're looking like on NVIDIA right now. Let's hop over to Alphabet. Google, Alphabet. This chart, again, one of the last survivors, I believe, right now of the Magnificent 7. You can see, first of all, I mean, just at first glance, you can tell how bullish this point and figure chart is. We just experienced another double top breakout, pulling back into the pocket perfectly, just perfect rhythm on this. Even from the point and figure chart, it looks great. Then let's take a look at the bar chart right now. So here's what we're dealing with today. It closed at 135.27. What we're doing, here's the 3/4 bear market number, 134.50. We took that out a couple of days ago, rallied up to its 1.618 of its latest price, which is right here. Totally acceptable. That makes a lot of sense to me that you would pull back from that. That's exactly what we did. And right now, though, we are finding support at that 3/4 bear market number, 134.50. Even today, we went below it, came back above it again. That isn't on this chart, but that's exactly what we did. But we are finding resistance right now at 135.80. So that number is what's keeping us in check. We've only had one close that looks like it was distinctively, maybe this one closed slightly above. This one barely closed above. And again, today, we did not close above 135.27. So that's a big factor I'm looking at. And that probably will happen again. If you break this trend line, you're going to probably break that too. What is also interesting, though, is I drew this trend line coming all the way down from the top. From the top of the bear market, and we broke that trend line, threw back into the trend line. Also, definitely holding up here at the 10-day moving average. Just a lot of positive things. One of the things you're going to notice, though, too, is this up-down volume ratio. Let's go over to this slide. Look at what this up-down volume ratio is doing. This is what you want to see when you're buying a stock. Not only is the absolute number showing extreme buying, and I have to say, when I see a big stock like a Google, a Tesla, anything like that approaching two or above, that is unbelievable accumulation for a big stock. And right now we're at 1.79 as other things are getting smacked. Not only are we at 1.79, look how we are breaking out above 100-day highs, going straight up on this thing. This is showing this stock is under intense accumulation right now in its base. So again, if there's any Magnificent Seven stock that I am bullish on right now, it would be Google. Again, it hasn't given me confirmation, but if you want to know that confirmation number, subscribe to my newsletter, and I will let you know when that does happen. What I'm probably going to use and put in my newsletter is I'm going to use the GGLL to purchase it. Why? I get an extra half beta for my effort here. I get 1.5 times the move of GOOGL by purchasing this. So I'm going to pick up that extra beta when I do this by using this ETF. And I've even got projected numbers for that right now. So this hasn't even been posted in the newsletter yet, but this will probably be in the weekend newsletter, the full report on this. Let's finish up here by talking about the regional banks. And again, just even yesterday on the regional banks, well, 2 days ago, I would say, I'm sorry. 2 days ago, we even played the regional banks. I put that in the newsletter. And again, unfortunately, the only way I can play these is, there's no ETFs that really pick up the regional banks as far as an inverse ETF. So I post to buy the puts, and that's exactly what I bought for myself. I bought the October puts, and in one trading day, we cleared out the position, the final amount of the position up 48%. And today, the regional banks still look really weak. So here's what's going on right now in these regional banks. Of course, from the bottom, we got a double top breakout. We got another double top breakout. But here's what happened most recently. Ran into that bearish resistance line. A lot of times moves will terminate at that bearish resistance line. And sure enough, that's exactly, especially when it's stocks or industry groups that aren't under heavy accumulation anyway, they will terminate at these bearish resistance lines on the point and figure. That's exactly what happened with KRE. Once that happened, that got my radar going on this thing again, because I played KRE earlier this year in March and made good money. Posted that in the newsletter too, where we made good money on the puts. But here's what happened recently. From that April low, we rallied up in the regional banks. We took out Here's a big number for me, 4760, a Fibonacci expansion number. Took that Fibonacci expansion number out for a little bit here, then started pulling in. But here is even a bigger number. This is the one that I keyed my whole trade off of. Once we took this number back, and by the way, how we took it back, when I see this too, when this is as strong of a number. Let me just say this, for KRE, for the regional banks, you cannot have a stronger number than this number. Why do I say that? This number represents not 50% of the bear market. This number represents 50% of the move from the bottom of 2009 all the way to the top of the move in the regional banks. This is 50% of the distance of that move. And again, 50% for me are strong, strong numbers. Always want to watch 50%. But when you get a 50% number that represents that big of a move, this is a number you need to focus on with the regional banks. What did they do? They took that number back. They look like they may have been in the clear again, and then they gapped the number. This is what put it on red alert for me to put that position on a couple days ago. For the short side is the whole move started right here. Once we started heading lower, what we did was we got down to my 3/8 move of this recent move higher. We got, or I'm sorry, that's 0.618 of that recent move. Here's 50% of that recent move, which I actually thought we'd test today. We didn't get down there today, but we started to reverse. Looks like we did it from my Andrew Pitchfork number, and we started to hold up right there. We'll see where we go, but here's how the whole move comes across. We break down. There's where we break that big trend line all the way from the bottom. Breaking 50%, breaking the trend line, holding though at 43.92. This is what allowed the bounce. Where did the bounce go back up to? Of course, they took it right. I mean, nailed it to the penny. They nailed 45.80, which is the 3/4 number. Rallied it back up to the 3/4 number, and this is where I put the position on. Once I got confirmation off of that number, that was where you wanted to put that position on. And of course, now we're getting the downfall move. Like I said, on the first leg down, made 48% on the puts. Now what I want to see is, do we get one last leg up where we rally and throw back into the trend line, back against 43.92 again, the 5/8 number, and then we're looking at these projections. And by the way, it could even get all the way down to 29.57 on these projections of coming down. This move is very unresolved. And again, the reason that I'm focusing on this when I'm talking about the S&P, I'm talking about the Magnificent Seven, I believe if there's any market movers that could move this market in that direction of down here as we're starting to break down again, I believe these are the areas that could contribute to that move. So again, where are we at on the up-down volume ratio right now on KRE? Well, we are in distribution right now, 0.82. And again, look at how they rallied us up. Barely got us above neutral, though. That's what I'm saying. When we were rallying up here, and by the time we were gapping back below 50%, we were back below 1 again. We were in distribution already at this point. So again, even at its best, as this thing was rallying up and we had these bottom fishers kind of coming in here and saying, oh yeah, the worst is over, and they're coming in on these regional banks, you could see it did not, versus the sellers, we barely got above 1, and now we're starting to fail again. So that's where we're at. And that's pretty much all I have for you. If you want more information, subscribe to my newsletter, and back to you, Steve. I will switch it over.
Great. Thanks, David. Appreciate that.
Okay. We
had a few recording and sound issues going on here, so we've been trying to resolve that. Hopefully the recordings can be edited and figured out.
Oh, okay.
Yeah. That may